Well, welcome. I'm Mariana von Lucken. For those that don't know me, I'm one of the tax partners here at HLB. I do present this every year. We have a little bit of a change up, though, to make it a bit more interesting. Well, what can I say? Happy Tuesday. Is it Tuesday today? Have you all had your dose of coffee? Yeah, good. Okay, there's not a lot of logs there. It's quite scary. Well, today's presentation will be given by myself and Helena. Helena Yu, where is she? There she is going to present the overview, just a short snippet to get a hand in there, and then I'll present the rest. Now, I've just got to say up front, there has not been significant changes in FBT, for profits or for not-for-profits. Now, that doesn't mean you can walk out the door. Sorry, Jen, there's a gentleman there that's getting up now. But I do want to run through some changes that have happened. And this year I just wanted to mix it up because there were a lot of changes in employer obligations. So I thought I'd mention those. And whilst you've got a large group of clients and non-clients in the room, it's always important to touch on these things just in case they don't get touched on at the year-end planning meeting. Just in case. So what's new in 2018, I'll run through. Other employee obligations, I'm going to run through single touch payroll. Some of you are very aware of it. Some of you have no idea. That's okay. Payroll tax, recent audit activities, what to watch out for if you have payroll tax. So not-for-profits here usually are exempt, only certain categories from payroll. But for-profits, if they reach that $750,000, they'll pay payroll. So it's not for everyone, but I think it's important to mention. Superannuation guarantee charge. This is a bit of a sleeper, and I want to go through that in a bit more detail. And also the proposed superannuation guarantee integrities, as if it's not hard enough already. And then I just want to touch on alternative employee remuneration. What else can you offer your employee? So I want to introduce Helena Yin. Helena's one of our tax managers here at HLB, and she'll be going through the overview. So give her a warm welcome. Thank you.
Good morning, everyone. I'm here to cover you some key matters that, as an employer, that you need to be aware of. Some you may already know, but hopefully I can confirm your understanding today. So what is fringe benefits tax? Fringe benefits tax is tax payable on non-cash benefits that the employer provides to employees. In the past, employees could receive non-cash benefits that in lieu of or in addition to cash salary that and didn't have to pay tax on that non-cash benefit. If it sounds pretty good to be true, well, the luck ran out in 1986. That's when the tax came in. There are two key features of fringe benefits tax. One is the tax payable by employers, as you all know. Secondly is a tax that corresponds to the highest personal marginal tax rate. So together, they pretty much tell you that it's designed to deter employers from offering non-cash benefits to employees. So I've got up on the screen some of the key dates in the FBT calendar year. So as most of you already know, FBT year runs from April to March the following year. FBT return is due on the 21st May. We don't have long to lodge this. If you're not lodging through us or a tax agent, is that 21st of May is your date. Tax is payable on the 28th of May. If you're lodging your return through us or through another agent, then you get an extended due date to the 25th of June. Well, again, you still don't get too long to do. But even if you get the extended due date, payment date is still 28th of May. So keep those dates in your diaries. Next slide I want to talk about is documentation and declaration. So why is it so important that we want to talk to you again? Because if you don't have this in order, keep somewhere safe, when the ATO knocks on your door, then that may very likely result in higher tax payable, hefty penalties and interest charges. So we cannot emphasize enough that make sure you have documentation, declarations in order. And we don't expect you to know all of it. Most commonly seen type of benefits is car fringe benefit. Logbook method is a must for those cars that are using operating method. As most of you may already know, that logbook is valid for 5 years, but if the change of use of those vehicles happens during the year, then a new logbook is required. If for the trips that relating to business, simply writing business entry on the logbook is not enough. Tax office will ignore any description, simply say business. At the end of the year, it's very important. The other declaration also important is LAFA, expense payment benefit, loan fringe benefits declaration. So there's a whole bunch of other ones that are not on the screen. Penalty, I'd like to also just point out penalty for failure to lodge. There's a range of penalty on the screen here again for you to see, up to $5,250 for most of you, but for significant global entities, because a lot of changes come through and they are impacting you, including failure to lodge an FBT return. A minimum penalty is $105,000. So that's no joke there. Meal entertainment. Why do we have this slide again? So for those who attended our seminar in the past, you may have already seen this slide. We put it up here again because people are still not getting it right. And it's a very complex area because meal entertainment benefits come into different shapes and forms. For example, the bottom line is if some meal and entertainment benefits are exempt from fringe benefits tax, then that, for example, under the $300 minor exemption, then those expenses cannot be tax deductible, income tax deductible days, and the GST credits on those expenses are not claimable. So that's the bottom line. We listed 2 methods up on the screen. There's a third one is 12-week register. It's not commonly used. I'd just like to ask the audience again, who here uses the 50-50 split method? Great, great. Good on you. Because it's the simplest method, but does not guarantee the best outcome for the employer. But it is the simplest method. The reason it's simple is you put all of your company's meal, entertainment types expenses in one ledger code, and at the end of the year, take 50%, and that 50% is subject to FBT. You can claim an income tax deduction, as well as claim your GST credits. And on the other 50% is the reverse. So no FBT, no tax deduction, no GST. And if you claim GST, that's one thing we also see quite frequently in our client cases, that the GST claim up front. And if you use this 50-50 split method, make sure you adjust your GST claim in that quarter. We will send you the slides and some, and in addition, an entertainment benefit matrix to you after the seminar. Hopefully this will guide you to code and categorize your company's entertainment and meal type of expenses. It's very complex, so you need a cup of coffee before you start reading that matrix. The next couple of slides, I'm just going to go through some common types of exempt benefits. The most frequently used one is the $300 minor benefit exemption. As the title suggests, it's $300, a GST inclusive value. This threshold applies to a per benefit type, per employee basis. So what does it mean? It means that when you have a Christmas party for your staff, and in that Christmas party, you give each staff a present. If both components, so the party per head and the Christmas present, is less than $300 per person, then those 2 items are exempt from FBT. So you don't group the values together to come to $300. You look at them separately. The only thing that you need to be aware is the component that's infrequent and irregular. There's no set guideline in the tax office or in the legislation on how many times you can offer your employee a minor benefit before it stops being eligible for the minor benefit exemption. In our view, probably up to 10 times, maybe different occasions, 10 times during the year. Between 10 and 20, a little bit grey, it really depends on the circumstances. Food and drinks consumed on the business premise, that is morning tea, afternoon tea, during a workday days. Your staff's professional subscription fees. We've got emergency assistance up there. It's just for immediate relief of a victim in an emergency situation. Also, I have not on the screen is taxi travels. Often you offer or allow your staff to take a taxi home or coming home to work with a taxi because of special circumstances. Any single trip that begins or ends at work, that trip is exempt from FBT. Living away from home allowance, I know it's not very, the application of that exemption is quite narrow now. If you have the employee moving interstate, keeping a home in their home state, you can still consider that. The portable electronic devices, 1 per employee, but Mariana will touch on some special conditions, some special exemption for small business entities. Last one that I'd like to touch on is relocation benefits, where you an employee relocated to a new office, new place of employment away from their home. Then the service of relocation consultant, storage or removal of their household goods are exempt benefits. Concludes my presentation for this morning. I'll hand you back to Mariana.
Well done, Helena, thank you. So what's new? Let's start. Some of you are already aware we had that temporary, budget repair levy, that 2%, so our highest marginal rate was 49 cents in the dollar. It's come down to 47, so that means everything shifts. So 31 March 2018 return, that is the FBT amount, 47. So the levy, the reason the levy's gone down, which you're all aware of, and that means also the gross up rates change. Now really all of this is really not important because your FBT software produces all that unless you're doing it manually, and trust me, a lot of people do it manually. Now just keeping in mind, reportable rate is 1.88. So whatever you work out to be your taxable value, whether it's type 1, type 2, when you get that taxable value, to gross it up in your reportable fringe benefit, like your summary, what you report on to the employee, is grossed up by that 1.88. Never by you don't worry about type 1, type 2 rate, it's always the type 2 rate. And remember that you only include it in the reportable, or reportable after if it's over $2,000 taxable. So $2,000 per employee. Now I wanted to clarify that next one, let me see, 1 April 2019. So not next FBT year, but the year after. Potentially the rate will go up to 47.5 because they have some legislation, there's a bill in there to move the Medicare levy up by 0.5. So just to be aware, it's not happening this year, it's not happening next year, or current year if you like. It might happen in for your March 2020, but you have to be prepared. Also rebatable employers. We have in the room a lot of not-for-profits, and some of those not-for-profits are rebatable and some are FBT exempt. For the rebatable employers, just to recall that the rate has gone, it's changed around, it used to be about 48 and then it changed, now it's 47. And so it aligns now with the tax rate. It previously didn't for some unknown reason. And as the rate changed from last year, the cap also changes, so just to be aware of that. So if you're a public benevolent institution, or if you're health, I think it's a health provision charity, prevention charity, then you do have these caps. And that's quite, and most of those are FBT exempt. Okay, so the for-profits don't get this. It's only, and the rebatables don't get this. They get a cap, but they get a rebate. Whereas this cap is quite useful when you're remunerating your employees. And why do we get these caps? These caps are there to align the not-for-profits with the for-profits in the sense of getting employees to work for them. So for hospitals and ambulance services, the rate is gone down to 17,000. So the cap is now 30 and 17, depending, and you know yourself who you are. A lot of these organisations use salary packaging providers, externals, to help them package. The additional cap is $5,000. There is still a substantial amount of opportunity to salary package. And I did a calculation at the not-for-profit event we held here. If you were on 125,000, for example, and you were getting your cap of 30, so here I'm giving you an example of PBI, then potentially you could be $6,000 better off. If you end up packaging some of your super on top of your 9.5, you might be better off 10,000. There has been, ATO has brought a draft ruling. Now this ruling talks about travel. Now why do we care about it? But it does touch on FBT as well, what is otherwise deductible. Now travel has been probably one of those questions where you think, well, how do I distinguish if the travel is deductible and the accommodation, food and drink is also deductible? And when I say travel, I mean taxi, bus, plane, not really taxi, bus, plane, your own car, etc. So if you are travelling from home to work, we already know that that in itself is not going to be deductible. So that's not going to be deductible because they can consider it sort of preliminary travel from home to work versus someone who's travelling on work. So to work or on work, really. This is what we have to deal with in tax. Now what the ATO has brought out some further guidance, and I think there's some benefits, real benefits there that I think employers could be using for their employees. Now they may already be claiming it all and didn't even know the difference. Well, now you've got some protection if that's the case. So ordinary travel home to work, preliminary, can't claim. But there are some, they've included these two definitions, coexisting and special demand travel. So special demand travel might be that a construction worker needs to work on different locations. He finishes one job, he goes to another location. So that may be the travel to go to different locations, even though he's going from his home to work, potentially could claim that. Also coexisting work, where an employer may have been working in Sydney and has to, as part of the employment, go to Melbourne. Now there is criteria around this. It's not as simple as I'm just saying. I'm just simplifying it for everyone. But you just have to recognise that if you potentially want to offer something to your employees, meaning they're working in Sydney and they're going down to Melbourne and they have to, as part of their employment, it's in their employment contract, twice a week. 2 days down there and say 3 days up here. So the travel down there normally you would have claimed, but the question was about the food accommodation. Could you claim that? And according to this ruling, potentially yes. And also if the employee has purchased a home down there and is paying for it, potentially, and the employer reimbursed some of the leasing expenses, say 2/5, potentially that could be claimed. There is provisos. They have to be travelling for work, they're required to be there, and your contracts have to show all this. If the employee pays for it, then the reimbursement expense. So again, same thing. The employer pays the employee. The interesting example they had was that sometimes an employer is required to work in a location for, say, 2 months. And the question is that a LAFA? Well, I give them a LAFA, which is an allowance, which doesn't come within these travels, it's an allowance. An allowance is normally accessible to an employee, but if it comes under the LAFA, then potentially it's not accessible to the employee that meets the criteria, and the employer gets the deduction. And that's how we, whenever it's more than 21 days, rule of thumb, thumbs, is that you would claim, you would go maybe using LAFA instead of, say, travelling. And now, with this ruling, it almost indicates that if you are travelling for up to 3 months, potentially it is still work travel, and potentially you don't have to use LAFA. You could potentially pay for the travel the employee does, pay for the accommodation, food while they're away, and then the travel in between when they come home. So long as it's all in their contract. There are conditions, so you need to make sure you follow the criteria if you want to do that or consider it. But it's something worth talking about if you do have employees working interstate for short periods and they're not under LAFA, or coexisting, management has to maybe travel from different locations, or you're in the construction business. Well, this was a fascinating, have we got bus line here? Yeah, great. So this might be interesting to bus providers, so people who have bus companies. That's everyone in the room. I thought this was great. I thought maybe we could offer this to our employees, but no, I'm not sure yet. There was a class ruling that came out, and it basically had the employer do a contract with a state-based bus provider. So there's an agreement between those two to provide their employees an Opal card to travel from home to work, and their salary packaged it. Fantastic, right? Sounds great to me. There were a lot of conditions around it, so if you want to do it, I think you'd have to do a class ruling or a ruling to the ATO to confirm that you can do this. Now, why can you do this for a bus and you can't do it for a train, ferry or another mode of transport? There's some quirky things, and I'm sure somebody thought of it when they did the class ruling, quirky things about the legislation, that if you have a motor vehicle and it's not, and it turns out to be a certain type of motor vehicle that is not a car, so that doesn't come within the car fringe benefit, it goes to residual benefit, blah, blah, blah. Anyway, residual benefit means that effectively there is provisions under that to say that if you're providing a car, which is not under the car fringe benefit, but it is a car, so a bus is 4 wheels, it's included as a car, it effectively can be exempt. Because as long as the travel is from home to work, now with all of these things, you've got to look at the detail, right? Got to consider the detail. So there was an agreement between the bus company and the employer. The employees were monitored. So they would say, they had to travel from Gordon to the city. That was their route every day, unless they moved or something like that. So the employer monitored that and said how many kilometres and blah, blah. And the state provider, the bus company, would provide a statement to the employer saying, what they did use. And then the employer would compare it. So if there was any deviation, abuse of those Opal cards, they'd have to be reimbursed. The employee would have to reimburse the employer. And also, if they left, the card would have to be returned to the employer. So it's quite specific conditions. But if you can come within those conditions, could potentially offer this as a salary sacrifice. Now, you'd have to go for a ruling and see if you could get it, but worth considering. Oh, Uber. I don't know about you guys here in the room, but we certainly said to our employees they couldn't use Uber, and we wouldn't reimburse Uber because there was a lot of probably liability issues and so on. But also there were other issues, and we couldn't come underneath that 58Z exempt benefit for taxi drivers that Heather mentioned. So what happens under the FBT legislation that says a taxi has to be licensed in the state, and that applies to our taxis, to come under this exemption. But it doesn't apply to ride source services like Uber or other like services. So therefore, you couldn't get the minor benefit. So if you send an employee home sick, just get a taxi, right? Out in front of the building, it's easy. Tax determination, like a discussion paper, tax discussion paper brought out, and that discussion paper wants to basically have a look at and ask a few questions, asking the public at large whether they consider that Uber or ride source services should be exempt, just like a taxi. and this would align with the GST treatment. So as you know, taxi drivers have to pay GST, even if they're under the threshold, and in a court case, Ubers were required to do that too, because they're carrying on a business. So what this discussion paper is talking about, should FBT be aligned to GST? Should they get the same benefits? That hasn't come through yet. That is only discussion, but just so you're aware. So keep doing what you're doing. If you're using taxis, so you get the exemption, fine. If you're using Uber, you might consider that it's not really going to be deductible under that, but it may come under minor benefits. So it may come under minor benefits if it's infrequent. And what's infrequent, as Helena said, who knows, 10 sessions, 10 rides. Now Helena mentioned we were going to talk about small business entities, and I'll talk about the definition of what that looks like in a minute. That's changed a little bit. But the benefit here is you can salary sacrifice your mobile devices. So laptop, computer, that's the same thing. Phone, see I'm really technical. All these kind of devices, tablets, portable printers, GPS, you could bunch them all together. Now previously you could get that anyway, you could salary package that anyway as an employer, any employer can salary package as exempt benefits, and each device is kind of unique, so you know you could provide one of those. But what this new ruling is saying is that you can effectively provide multiple devices. So you could provide 2 computers or 3 to that employee should they need it, but for work. So you can't provide an employee with 2 computers, one for their child and one for them. So it still has to be primarily for business use. Now I can't think of a situation where an employee may need 2 computers, but, oh yes I can actually, just came to me. Maybe I'm using the computer at work, I don't want to drag it home every night, so I buy one for home. You know, that's a really simple example, right? That might be the benefit there. Now you have to still be providing it for work, and you know, the employer would really need to declare that it is mainly for work. And also, I think has to be salary package, or this is an opportunity salary package a few more devices. So that's great there. Now the main thing is that it has to be for work, and you have to be a small business entity. And most of you are thinking, I'm not under that 2 million turnover mark, so geez, I'm out. But there's been an update of the legislation, and the turnover test from 1 July 2016 has been made to 10 million small business entity. It's quite confusing in the Tax Act, I think, and I feel sorry for clients in a way because there's so many conditions that you have to take into account. So you have to be a small business entity for FBT purposes, and you're looking at turnover tests of 2 million and 10 million, and when is that, and is it aggregated, all those kind of questions. And then you look at the tax rate change for small business entities, which is quite different section of the Act. So if you've been reading the news lately, or you know from your tax returns that if you're a small business entity with turnover in the 30th of June 2017, 10 million, you get a reduced rate, right? So they're a small business entity for rate purposes, for FBT purposes, and for capital gains purposes. So small business concessions for capital gains, turnover is 2 million, it hasn't changed, just because the rates change. So with the rate change, you had a 2 million, a 10 million now, and a 25 million in 2018. But that is only for the rate, so keep that in mind. When you're looking at FBT, I just confused you totally, but when you're looking at FBT, you're looking at that 2 million turnover or 10 million, and depending on where you fall. Exempt vehicles. So some of you are in the room are aware that you can provide some vehicles, some types of panel vans, utes, to your employees under 1 tonne, carry no passengers, to your employees as not a salary sacrifice arrangement, but as a tool. So it's provided to them, and that means as long as they travel from home to work, no issue. It just means to travel for homework. What happens if I stop over and buy a newspaper that deviates for 2 kilometres? What happens if I happen to use it on the weekend to move something once a year? And what these guidelines are producing is giving you that assistance for those that are providing these exempt vehicles. This will give you a little bit more assurance, I think, a little bit more assurance as to when you are providing them, that these vehicles are truly exempt. That's what it's trying to do. So make sure that the vehicle is an exempt vehicle. That employers have got that wrong. And you limit your private use. So we limit it to work, but what it's saying in the ruling is that you limit it to a deviation of, say, 2 kilometres. So example is, every morning this guy comes to work and he deviates, he goes to get his newspaper and then comes to work, which obviously is deviated from straight home to work. And then no more than 750 kilometres outside of that home to work at the end of the year. And no journey, return journey, should be more than 200 kilometres. Oh, bit of guidelines. And then you've got to monitor it. Is it worth it? Probably, because there is a lot of benefit in having this exempt benefit. And who is it provided to? Sales representatives in pharmaceutical companies, sales representatives in other companies. So there are reasons why you might want to do this. Now, it can't be salary packaged, so you don't package tools of trade. You provide them as part of their role. Very important. It's got to be a vehicle that's that hasn't had business accessories put on it. And it's got to be under the luxury car limit of $65,000. So there's a bit of criteria to think about, right? It's not as simple as saying, yep, provide it to any type of vehicle. It's got to be a tool of trade. So it does have some definitions around it. So if you, for example, decide, and monitoring is important, so employer knows when they provide these vehicles what the kilometres is from home to work, and at the end of the year they get the odometer reading, so it's important to keep the odometer reading, opening and closing, and then they compare it. So as an employer, you can use these guidelines if you do this, and once you've done it once, it becomes second nature. Is you compare the kilometres they travelled to the kilometres that they should have travelled from home to work, and the excess, if it's less than 750, should be okay. And that each trip, return trip, within that 750 wasn't over 200 kilometres. Fleet cars. So fleet cars, they do have a lot of criteria around it. I think if you fit within the criteria, it's not new. The fleet cars have always been there. It's just provided a bit more guidance as to what is a fleet car. So it's offered to 20 vehicles or more. So you've got to be an employer that has 20 vehicles. And so what is included in these 20 vehicles as part of your fleet? And fleet cars are like sales reps. If you have sales reps and it's a tool of trade, as I was talking in the last example, it meets all that criteria, it can form part of a fleet car. Now that wasn't known before, but it is now, and that's what this ruling is talking about. So the benefit of the fleet car concession is that previously, if you did have fleet cars, you had to get every employee's logbook. Every employee's logbook, if you're using the operating cost method, right? So it's hard to get 100%. So this concession offers, if you've got 75% logbooks for eligible vehicles, and I'm going to just chat about what that is, and it meets all this criteria, then you can use the aggregated as those 75% business use kilometres for all those logbooks, if you like, and apply that amount instead of having to do an individual amount for each individual, if you like, individual percentage. So it's an overall. So it's a great concession. You've got to go through some loopholes. Okay, so just be quick with this. What qualifies as a vehicle to be part of the fleet? So car, private use is minimal, like I was talking about that ruling previously. It's not necessarily available for private use, but you do have that private use. Hire car, if it's more than 12 weeks, then it can form part of the fleet. It meets certain criteria. And I mentioned that it has to be qualifying. So that's more fleet cars. So strategies to reducing FBT. Employee has a rental property and they have interest and they want to salary sacrifice that interest, and it would have been deductible, otherwise deductible rule. Keep declarations. $1,000 in-house benefit reductions. there has been some changes and constraints in this rule, but it's still available. Employee contributions. It's well known that if you salary package for for-profits, that employee contributions, do reduce the FBT amount. So it's worth doing that calculation. Whether we do it, you just get a salary package outsourced provider that just does that for your employees, whatever works really. So what attracts the ATO's attention? Cars, you have cars in your P&L, but there's no cars, no FBT return lodged. For rebatable employers, they're not rebatable. What's a rebatable employer? Sports club, association, maybe a golf club. You have to fit within one of the criteria, a not-for-profit, which is either in the Income Tax Assessment Act, sorry I mentioned that word, or you are not-for-profit that meets the criteria. So it's not everyone. But some people self-assess, because under the Act you can self-assess, and they're self-assessed incorrectly. So non-lodgement of FBT returns when there's clearly meal entertainment and all these other things. Now there may be a good reason why you're not lodging. But always keep in mind, if you should have lodged an FBT return because you had employee contributions or otherwise deductible made it nil and you decide not to lodge an FBT return, it's open for the ATO to come and investigate any time. Otherwise, if you lodge, you've got an assessment period, and I think it's 3 years. If I'm wrong, 3 years. Car parking, just the valuation method. I mean, there's so many things you can get wrong there. And LAFA, well, LAFA is really constrained concession now, so it's really narrowed who can get it. But now with that draft ruling, potentially, you could do travel. Anyway, something to think about. Employer obligations. So I just want to come through some of this, and you might think, well, why am I looked at single touch payroll. Initially when I looked at it, I thought, oh, it's not that really complicated. But you'd be surprised that people aren't aware of it still. So what happens is that 1 July 2018 is the cut-off. If you have over 20 employees from 1 April, you are in these. You have no choice. You're in. There might be some exemption, I'll go through that. But you're in. You can't get out of it. You'll be penalised if you don't do it. Now, what is it? What it is basically a streaming, like super, I guess, but that is specifically a payment going to super stream. This is any information for PAYG withholding. Super will go into employee shares, will go into to the ATO straight away. So instead of reporting in your annual summary statements at the end of the year, you won't have to do that because it'll be done automatically through the ATO. So you need to make sure your records are up to date. Now, what does it mean 20 or more employees? Does that mean if it's companies are grouped together, or is it, if they're independent entities? How does it work? So 20 employees can be for the entity itself or where you're grouped, 100% grouped. So if you've got another subsidiary or a head entity, 100%, and they've got employees, you count them. If you have 20, you're in. And if you're in, that means you have to go and contact your service provider if you're using one. Xero. If, for example, Xero, and there are others, I know, SAP and so on, do they have the software, will they have it updated so that you can implement on 1 July? So it should be automatic, right? As long as the software provider has done this. Now, if a software provider, which is not a common software provider, is not ready, then they will apply to the ATO and get a deferral number. And once they've got that deferral number, then effectively they can give that to you. And you can use that. You don't need to tell the ATO anything, you just got it. And once the software provider has updated, you continue on as usual. Okay? Now this will apply to all employers from 1 July 2019. So you may not meet that criteria now, but you certainly will later. There are some exempt people, and that is, rural locations, kind of say. Rural locations, you might not have very good internet. So you can request an exemption from the ATO. Or you only have maybe 20 employees for a short period of time. Fruit growers, pickers, that kind of thing. Then you have to request an exemption. Don't just assume that it's all okay. And so there's a link to that deferral, should you need it. So we'll provide that in that email. If you're not ready, just ask for the deferral. So I think it's just to be on your radar that the upgrade must come through. Payroll tax, another pet pet area for the OSR. They love it. Payroll tax, not the tax office. This is OSR. I just want to clarify, not your PAYG withholding. OSR, Office of State Revenue for New South Wales. They're all different ones. Queensland, depending where your workers work. So you've got to keep that in mind as well. Now the areas they attack are grouping. These are famous. There's a lot of cases. Employment agency, when I want to run through a little bit, and contractors. Now, as you all know, as grouping, it groups where there's control. So it's not just about 100% ownership, it can be controlled. So one director controls another entity, they could be grouped. And some of the cases have been about degrouping. You know, there's three brothers, they had a fallout, they wanted to degroup. But in the end, the High Court said no, they're already interlinked. It's really hard to say that they're fallen out, if you like. There's a lot of other indicators there. So it didn't allow it. With the contractors, as you know, if you've got a relevant contract, independent contractors, you can come under some exemptions. So they're really quite useful. And when you employ people, you might think, oh, they're a contractor, you know, you're paying their company. Yep, okay, great, no problems. They're outside payroll. But remember, contractors, externally paid people can be caught under the payroll provisions. There might be a reason why they're not, and that's because there's an exemption. But you need to consider it. Now, employment agency. Why am I mentioning employment agency? I think this is really one of those sleepers. Legislation's always been there. So employment agencies, if you come within the employment agency provisions, you can't come underneath the contractor exemption. And that's what's so important. So if the OSR deems you to be an employment agency, and I want to give you an example of what that looks like, then potentially you don't have these exemptions and you just have to pay payroll. Now, in all cases, you have to look at the facts of each taxpayer, and the examples I'm giving you, it's like a bit of disclosure, isn't it, are very simplified. There's probably other things that I haven't mentioned. It's very hard to mention everything. So where, for example, an employer had employees and they've been, so client makes services to agricultural businesses and provides them people to do fruit picking and all those kind of things. So the employers here provides employees to an organisation. So they're working in the organisation. So fruit pickers might be security guard. They're working in the organisation, they've got little jackets. Now, if those employees have been employed by this entity, the employer, no issue, because that's just going to go in payroll. But if they've hired some independent contractors to do security work, to do other roles, does that cost go as part of your payroll? Now, some have seen it as no, because they've gone, oh, they're contractors, they come under the contract exemption, and boom, they're out. That's what employers have thought. But then what happens is they've gone against the OSR, they've taken them to the AAT, and then they've gone further, tribunals, and then they've said, actually, you're working in that business. Those security guards are working in that business. So you are an employment agency hire organisation. So therefore, you have to pay payroll tax on those independent contractors. So that's what it's trying to get at. On the other side, so so you can imagine the OSR is trying to grab everyone. And where there's been situations where there might be a welding business, so for example, it's provided independent welders to do a job, to complete a job. Like, say a builder gets subcontractors to complete a building. Now, they're not working necessarily in the business, they're working for a result. And with the court case that's gone through with these welders, it's indicated these independent contractors that have worked for the welding company were there and working on that client's business, but to produce a result. And there's contracts to identify that. So very important when you're looking at payroll tax, how are your contracts written? OSR, the courts have decided, not the OSR because they want it in, that those are working not in the business, but to produce a result, to provide advice. They are clearly independent. So those independent contractors can come under those exemptions or contractor exemptions. Now, they still have to go through that process, but it's a little bit clearer. So it's really hard to distinguish. It's a bit of a mind mind wreck, but yeah, so you have to go through that process. Oh, I want to mention this. I think this is a sleeper. We came across this year for another client, and it's difficult because clients, you know, they've got their super obligations, you know, super annual guarantee, your 9.5, and every month you pay it, some of them, smaller business might pay it every quarter. You're obliged to pay quarterly, by the way, not yearly, quarterly. And so you come to the end of the month and you pay 28 days after, bang, you put it in their super account, all forgotten. Should be automatic. If you outsource it, easy. If it's done internally, don't forget. That's all I can say. Because if you get it wrong, there's a super annual guarantee charge, and that means there's an additional shortfall charge, there's an interest, and there's an admin charge. And it's not deductible. Thank you. We can all go home. It's just ridiculous. But what the ATO was providing was an administrative sort of concession, if you like. It's not law, but they were providing it up till recently. To get it, it's quite complex. And again, I'll go through it very simply. But if you look at that timeline, and unfortunately, this is the only way to do it because it's quite detailed. But if I won't go through the facts, but effectively, you know, an employer normally pays their super guarantee. So they've got January to March is their BAS period. So this is a quarterly provider. Okay. On the 28th of April, they normally pay their super. If you do that every quarter, you're okay, fine, no problem. Don't worry, don't listen to me any further. If you get it wrong for whatever reason you forget, and you pay it on the 12th of May, now usually what would happen is that on the 12th of May, you should lodge a super annual guarantee shortfall form, which I am sure 100% that a lot of employers do not do. But if you get audited, they will require you to lodge that form. But assuming you are a diligent employer, and you do lodge that form because you are aware of it, then the ATO has had administrative charge of between the time you should have paid, which was the 28th of April, to the 12th of May. So the interest component, not too bad. Right? They might have charged, there might be 10% interest, yes, $20 for the shortfall, etc. And the calculation of shortfall is based on salary and wages and not ordinary times earnings. So there might be a shortfall there as well. But assuming that they didn't have all that, there was a bit of a concession there. So what we've discovered is if clients get audited and they haven't paid on time, it's not hard to check this, right? Once you're in an audit situation, what they'll do, and you haven't lodged an SGE, so in this example, 12th of May, you haven't lodged your SGE, just SGC form, got to say all these acronyms, then what they'll do is they'll say, lodge that form now, so you lodge it, and it may be on the 7th of September when you're lodging it, a couple of years later. It's not uncommon. You might have 500 employees in the scenario. That's a lot of employees, right? So we did a bit of a calculation just to show you the difference. But in effect, what happens is the ATO said, no, we're taking it from the time, the beginning of the quarter you were late, so 1 January, the interest component, to the time that you lodged your SGE form. Not that you made your payment, but you lodged your form. And they're charging you 10% interest, so over 2 or 3 years. That can be enormous. Remember, this isn't tax deductible either. So, and on top of that, you've got an admin charge, and on top of that, you've got this, your salary and wages, and this is why the example shows salary and wages of 11 million versus 10 million. Salary and wages can be different to ordinary times earning when you're looking at payroll tax, because there might be overtime and things like that in there. So you have the shortfall. In this case, the shortfall was $95,000. So the difference in the interest and all up, you could have substantial difference in what you end up having to pay. And the more employees, the worse it is. So to me, I think that's a bit of a sleeper. The legislation has always been there, but the ATO has had a concession, if you like. Their internal concession, which is not written down anywhere, so they can change it any time they like because the law is the law. And we've had a close look at it, and unfortunately, that is the case. So I would just advise you to make sure you pay on time, you don't skip a payment, or if you do, hopefully the ATO won't come knocking. And then if they do, you might want to make a voluntary disclosure before they go through anything. To make it even worse, The integrity measures, there's a bill coming out to say that if you don't pay your superannuation guarantee, when the commissioner sends you a notice, they call it a direction, but a notice, you could effectively go to prison. That's great, lovely. And that's supposed to start 1 July 2018. Now, what has the ATO, what has the professional bodies been doing about it? Well, the Tax Institute that we're members of, they deal solely in tax, have made a submission to the ATO. Not that submissions really ever count, because sometimes they listen and sometimes they don't, but just said we already have harsh penalties. Really, is this appropriate? Maybe it should be on the second notice, not the first. You know, people are always trying to do the right thing. You just get, unfortunately, there's always just some rotten apples. So they're coming down heavy. The only thing I see is that without this administrative concession and just taking aside these harsh penalties, is that the money all goes, the interest component all goes to the employee's super. They've already got the money a month after, not, you know, so they're getting now a benefit of 2 years. So that's what doesn't quite make sense. This is not the ATO taking the money, by the way, the interest component, that goes to the super fund. The ATO takes that $20 administration charge. So alternative employee remunerations. So you might think, well, how else do I remunerate my employees? I've salary packaged, I've done everything I can, I've used my caps and not-for-profits. What else can I do for them? And something to think about, and why I'm raising it this year is, I think it's important because there has been some concessions. So from 1 July 2015, there are some concessions for startups. And startup definition is quite broad. So if you offer employee shares and you're a startup, you can get some really good concessions. Basically, there's no taxing on any discounts if you meet the criteria, and you only pay a discounted capital gains when you eventually sell it, assuming you've held it more than 12 months. Real benefit there. Now, you can provide the startup concessions, or you can provide the employee share provisions and option outside of the startup concessions. There's more rules and regulations around that. It is a costly exercise to do it outside of the concessions, but it is something we can assist you with. And you have to be careful how you construct the plans so that you're not paying either anything up front initially and it's only paid at a later point. Another popular one that we have done a lot of and employers like is loan plans. Loan plans are where the company lends the money to the potential new shareholder, so they're not already a shareholder, as a non-recourse loan, and then they put the money back in the business effectively and get issued shares. Now the benefit of that is that they're doing it at market value. The loan is by the employer, and they only pay the interest through dividends. So when the company pays dividends up, it reduces the loan. And it's non-recourse, so if something happens to the company for some reason, they can take the shares, the value of the shares at that point, but if the loan is larger, there's no recourse to come back to the employee. So there's some real benefits there. It's the simplest form without even delving into these employee share provisions. Now, why I've got a timeline there, just so you know, is that there's been two main changes to the employee share provisions. So if you look at it, at that point, it was all right. At that point, you wouldn't be offering options for employee shares. It was really quite bad. And then the rules have come back again, and now they've offered the startup provisions and offered more concessions to the options. So they're back in favour, if you like. So that's why I just wanted to mention it. And some of the concessions are in this handout. And I thought to myself, they're not really that difficult for some businesses to meet the startup provisions. You're not going to be a listed entity. Well, that's fair enough, you're not probably. But it's going to be incorporated, shares being issued for less than 10 years. So 10 years, 10-year-old company or 9-year-old, 8-year-old company potentially get, be a startup under these criteria. And it's issued, the issuing company has an aggregated turnover of less than 50 million. And then there's a market valuation rule. And there's also concessions as how do you calculate the market value of the shares. But there's some concessions there. So you could use your net asset value. But not everyone, but some. Also, the ATO has brought out a pro forma employee share and option plan and an offer letter. Goes a long way to do it a little bit cheaper. Now, I still recommend a lawyer look at it. Now, what will you get after this session, or how can I sum up what we've talked about today? So FBT review, as you know, not too much has changed. Single touch payroll, be ready. Count your employees. We're past 1 April, but I think you know who you are. Payroll tax. Auditors are always out there. If you think you might be an employment agency, review an employee super guarantee charge. So maybe make sure you're paying that on time, or your provider is paying it on time. And consider alternative employee remuneration. Have you thought about the startup provisions? They are quite generous, so maybe that's something you can think about. Thank you very much for coming today, for taking the time out to come and listen to Heather and myself talk about FBT and employer obligations. So thank you. You are most welcome to speak.